Hello, everybody. Welcome to Macro Money. This is Ilya Spivak, head of global macro at tastylive. And today we're going to be doing a little bit of a survey of all of the massive event risk that we've had over the past several days. We've had just about a week of just relentless monetary policy updates from all of the major central banks. And now we're going to have a lull for a bit. We're not going to have as many announcements in the coming weeks. But of course, the changes that have been wrought here are significant and will matter. So we're going to take a look here at what those changes were, how they're likely to impact markets, and where we are set up for really what is the underlying cost of money across economies for much of the rest of this year. We're going to begin with a little bit of survey of how this works. And to do that, we necessarily have to look backwards. We, unfortunately, are yet to invent a time machine or a crystal ball that is reliable. And so really all we have is the guidance of history when we look at how monetary policy impacts markets. So we're going to start with a look at how this worked last year in hopes of then gleaning how it's going to work this year. And this is a chart you all are surely familiar with. On the bottom is the amount of interest rate change for a given major economy. And here I have the G10 major economies. And then on the vertical axis, I have how well the currency of that country or region performed given those changes in policy. And you can see here, there is a line that approximates the trend here, the dashed line, from the lower left to the upper right. And what that's telling you is when interest rates have gone higher, the currencies associated with those central banks and with those rate changes have done better for the most part. And we're going to get to that caveat there, that for the most part, momentarily. But that is the relationship. Essentially, what we see is that when interest rates go up, the attraction of assets denominated in those currencies, this is not just an FX story, this is an assets of a country story, those assets become more attractive. I want to be very clear here that this does not mean that those stock markets become more attractive, because that's not necessarily the case. For example, over the past year, we've had very sort of comparable performance from stock markets in Japan, in Switzerland, the Eurozone, and the US. All of them moved a sort of similar amount down, give or take 20% over the past year, but clearly, as we can see from the chart here, the response from the currencies has been very different and arguably much more consistent. The FX market is much more liquid. It is much less subject to near-termist thinking. It is much less inherently biased long, and it looks at markets from the perspective of the lender, which is to say, higher interest rates mean a better return on assets denominated in that currency, as opposed to from the perspective of the borrower, which is higher interest rates mean it is more expensive to finance economic activity, which is how stock markets tend to look at it. So we are looking here at the attraction of assets by region or by country as it is summarized in FX. We're not saying equities specifically, though, of course, it is an input to some extent. So let's break this down and see how this worked last year, and then we'll figure out what that means for the rest of this year. It is certainly, I should think, not surprising that the best performing currency, up almost 10%, and the worst performing one are the ones where the rate hikes were the most aggressive and then the least aggressive. So the US had the most rate hikes, the dollar was the best performing currency. Japan had no rate hikes. It was the worst performing currency. This is not surprising. Obviously, we can see here that virtually every other currency had its yield return move ever higher relative to Japan, which was standing still. Not surprisingly, capital went to where returns are greatest, and that was very clearly not Japan last year. Where we have a bit of ease explaining the deviations here are Switzerland and then the UK. So Switzerland, you can see the currency did exceedingly well, second only to the US dollar, but the magnitude of interest rate hikes was relatively modest. This makes sense in terms of the context of the war in Ukraine. Much of continental Europe is tied up in that situation, either via NATO, via the Eurozone, via proximity. Switzerland is historically neutral and is something of a regional geopolitical haven that way. Not surprisingly, it's done well despite having lower rate hike numbers. Compare that with the UK, where the currency didn't do very well, even though it's relatively up there as far as how many rate hikes the Bank of England did last year. That too makes sense. We had 3 different prime ministers in the UK in just a few weeks. So lots of political uncertainty there. Markets hate uncertainty. In some ways, even a bad outcome would be preferable to an uncertain outcome because at least one could allocate portfolios for that bad outcome. In the UK, there was a lot of instability. Those assets didn't look especially attractive. No surprise there. Now we get into how it was that the Eurozone and the Euro outperformed relative to the likes of Norway and Sweden, where the rate hike numbers were about the same, but the currency in the larger region, the Eurozone region, clearly did better than the krone and krona, Norway and Sweden's currencies. And here lies a very important relationship between end demand markets and vendor markets, which tend to be the markets that ultimately service that end demand. And here I think an analogy is perhaps most useful. Just consider who is better off in an environment where the cost of borrowing is rising and economic activity is slowing. The customer at a fancy coffee shop or the barista? Norway and Sweden here are the barista. The Eurozone is the customer. So the market looks at this and says, things are slowing. The environment is getting more challenging. It's becoming more expensive and more difficult to borrow money. Where should capital go? Well, typically things get defensive and they go to the place from which demand originates, not from the areas which depend on that demand. And this is a relationship that carries over not just for the Eurozone as relative to Norway and Sweden. It's essentially the same thing going on between the US and Canada. Again, very comparable interest rate hike cycles last year, but the US outperforms. Why? Again, in a defensive environment, in an environment where economic activity is more difficult to achieve, capital moves from vendor markets that depend on demand from someplace else to the place where that demand is local, the place where that demand lives. Very similar story. You can also compare not just across themes and thematic groups, as we've done here with Europe and with the US and Canada. You can also compare within those groups. And here again, not surprisingly, interest rates are the differentiating factor. Take the Eurozone against the US. US has more rate hikes. It does better. Consider vendor markets against vendor markets. Norway and Sweden have fewer rate hikes than Australia, New Zealand, and Canada, they don't do as well as those economies. Those areas where interest rate hikes are greatest, that's where you get the gains. Now, with that in mind, what did we hear from central banks in the past week or so? As I say, we've had major announcements. And where does this leave us? Well, let's take a look first at the big one. And the first one on the list, ostensibly, sorry, Bank of Canada, your announcement was in January, so you just missed the cutoff here. We're looking at specifically this month because there's certainly enough fodder there. So we can see that since the Fed announcement, that announcement was on the 1st. I'm looking at essentially what's happened from the day after and since to kind of give things a chance to settle on the day of. And you can see the bottom line is the U.S. yield curve has shifted higher. This has been helped along, of course, by that very impressive jobs report that we saw on Friday. But it's also arguably been helped along by the kind of easygoing tone that we got from Chairman Jay Powell at the press conference following the Fed announcement, which he repeated again today in an interview with Bloomberg, where he signaled that unlike his more combative stance in December, he doesn't feel the need to push back against economic activity getting a little bit more effervescence behind it. Doesn't feel the need to push back on financial markets, getting a little bit more chipper and a little bit more risk-minded since the fourth quarter of last year. And so what we've gotten here is a push higher in the rates curve, which seems to generally align with a little bit of a higher terminal rate and slightly higher rates all along the curve until we get down to basically 3% 3 years out. So big takeaway here from the Fed and subsequent big splash data, a slightly more hawkish rates path going forward, and one that probably gives us a peak rate somewhere in the 5 to 5.25 target range. Looking at the ECB, somewhat of a different situation here. The terminal rate is expected to be reached faster. So you can see now we're looking to reach it within 6 months. We see that it's also a little bit lower. We were going to poke a little bit north of 4% on the reckoning immediately after the policy announcement. You can see that's been essentially recentered a little bit, and it looks like we're going to hit it a little bit earlier. The interesting thing with the ECB is they effectively gave us a 50 basis point rate hike and then pre-announced another one for March, essentially saying, look, we're going to do this again. We're telling you that we're going to do this now so that we can stop after. So don't even speculate. This is what's going to happen. So, in a sense, they sort of took the wind out of the market's sails there. There might have been much more speculation on a more hawkish ECB had they not done that, which is interesting in and of itself because it tells you that the ECB isn't really comfortable with the markets running away with the hawkish narrative. For the Bank of England, very little change in what's been going on here. Obviously, the central bank has unequivocally said that recession is nigh, that it will continue for an extended period, that we're probably going to be looking at weak growth all the way through 2024. And so very similar to what we see in the U.S., another country where we've had really aggressive tightening in the wake of really aggressive fiscal stimulus following the onset of COVID. Very similar story and very similar yield curves. So a peak just in the mid fours and then a year out from now, the deceleration and the easing already underway, settling right in the vicinity of 3% as well. No big shockers there. And then just last night, Australia. Here, there was a meaningful shift higher in the yield curve, and it is important to note it's only been a day. So this hasn't quite settled yet. There's still quite a bit of economic data out of China, Australia's main export market, that's due this week. We'll talk about that on Macro Money tomorrow, so definitely tune in for that. But here you can see we've had a shift in the yield curve that's much more in line with some of the peaks in rates that we've seen, for example, in the US or in the UK. So again, in the mid fours for the peak, and easing looks like it might be starting a little bit later in the cycle. So it looks like we might hold at these higher levels for a bit longer. The Aussie dollar responsive to this, a little bit higher, tellingly not very much higher. And so the reaction function between what the Australian Central Bank is doing here and everywhere else is interesting. They seem to be saying they're going to hold rates higher for a little bit longer, maybe about 6 months longer than, let's say, the ECB or the Bank of England or the Fed, at least on current market expectations. And they're going to reduce them a little bit less. So this is a relatively rosy view, considering Australia is such a cyclically minded economy, and probably speaks to a sort of expectation that we do get a sort of soft landing and a sort of Goldilocks response from global markets, deflating or disinflating, to be technically accurate, around all of this global tightening that we've seen in the past year and a half or so. This is what it all boils down to together. So these are the current yield curves for the four central banks that we're talking about. And what you immediately see here, just putting them all together like this, is that up to a year out, so going into early 2024, the U.S. has a positive rate gap against everybody. Certainly these four are not all of the economies of the world, but they are together an absolutely commanding share of global GDP. Between the US, the Eurozone, and the UK, and Australia's leverage to China, we're looking at overwhelmingly the macro narrative for global growth here. And what we're seeing is US rates that are expected to run significantly higher than elsewhere, but then end up lowest of the bunch as you start to get clustering around the 3% level when you look either 2 years out or 3 years out. And at this point, regional differentiation is very modest. We're sort of within 50 basis points, give or take. But more importantly, it's really difficult to see through the fog of uncertainty that far out. So this is arguably not something that is an actionable trade at the moment. However, looking 1 year out, it certainly seems eye-catching that after everything has been shaken out here for these major central banks in recent days, it is the ECB that's expected to have the lowest rates over the coming year. It is Australia that is sort of doing a bit of catch-up and is expected within a year to edge out the UK narrowly. But it is the US where rates are going to remain strongest in the sort of investable, tradable near term. And this is an interesting setup because, of course, exactly as this occurs, the US dollar has pulled back and is flirting with support in that 26.50, 27.19 area on the Invesco US dollar ETF, the ticker there UUP. This is essentially an approximation of the baseline US dollar index. The future there is DX. The overall US dollar index basically takes the value of the dollar against the basket of major currencies. This ETF does the same. This is a monthly chart. You can see that the dollar had an absolutely stellar run higher, has been trending higher for really since 2011 in broad terms, and kind of stair-stepping it with certainly large periods of consolidation along the way. You can see the period roughly from about 2015 through 2021 is mildly sideways, but the overall trend certainly looking higher. The onset of this tightening cycle in 2021 giving us an explosive breakout higher in the direction of 31. The high there you can see 30.76. And then the recent thinking in markets that the Fed rate hike cycle is almost over, that the story for risk sentiment is improving because the rate hike cycle is almost over. All of those things have given us a dollar pullback through the fourth quarter of last year, and certainly up through, let us say, the start of February or so. Since then, the dollar has perked up some. Just as it retests this former range top, 26.50, 27.19, which had us capped for years and finally gave way, retesting it now as former resistance becomes support. And you don't need to be a big believer in technical analysis to look at something like this and say, well, there was clearly a ceiling for a long time. That ceiling around the $27 handle has been roughly in place. You can see looking back here since at least 2008. It is understandably eye-catching when you overcome that level, whether you believe it has any kind of technical significance or whether technical significance is even a thing that you take seriously. It is without a doubt eye-catching that a level has been notably a ceiling, tested multiple times, and then not. So receding back to that level and watching how the price is going to negotiate that level is something that's eye-catching and something that would generate market activity. Again, whether you believe in the merits of technical analysis at all, or you don't, just because it is such an observed phenomenon. And if something is so observed and so ubiquitous on the minds of investors as to then generate buying and selling depending on what happens, well, then it really doesn't matter if technical analysis has any implicit powers or not. What matters is there's buying and selling that occurs. And that buying and selling is what gives you market outcomes. So it really doesn't matter if there's any technical analysis that is giving you a kind of early lead or that influences markets in some sort of way. What's important here is the self-fulfillment component. If everybody is watching this 27 level, give or take, and will act based on what the price does at it, well, then the level matters, whether it had any kind of technical powers or it didn't. So this is a very interesting place to find ourselves, because as all of these market forces get to a maturity level, as we get increasingly locked in on what we think interest rates are going to do, and knowing what we know about how incredibly important this was, even just looking at the price action last year, we're left with the conclusion that the dollar still has the most attractive yield profile going forward. So if we get a soft landing, well, then you get higher U.S. rates and the current outlook broadly holds, and you are paid to hold dollars relative to other currencies. So perhaps we bounce from this level after that correction over recent months. If, on the other hand, the soft landing doesn't work and the Fed turns out to have been more optimistic than reality ultimately bears out, because as the tightening starts to squeeze, we get some sort of tension in the credit markets, something snaps, much like it did with far lesser tightening over a less blistering sort of pace when we did this last time in 04-05. That, of course, gave us the global financial crisis in 06, 07, and 08, slowly building. If we are looking at something like that, as we've talked about before in our conversations about the dollar smile theory, the dollar does best when either the U.S. is doing really well relative to other economies or the U.S. is doing really poorly relative to other economies, because then you get a haven effect. Capital moves into the dollar because it is the most liquid and thereby the least jumpy and the most able to absorb that capital in times of stress. The more liquid something is, the less volatile it is. So when people cash out in times of stress, the question of which cash one does that into, of course, comes up, and the U.S. dollar wins out most of the time. For obvious reasons. Easily the most liquid. So with that in mind, if you don't get a soft landing, you may yet get a bounce in the dollar anyway, on those grounds. And so we find ourselves in a really interesting position. And as the dust settles on all of this central bank activity, we seem to be left with much the same story, albeit with a little bit less intensity and vigor, as we had last year. Only this time, it may be that we have a bit of an improved risk-reward profile if one is a buyer of dollars, thanks to the pullback over the past 3 or so months. And that has been Macro Money. I am Ilya Spivak, head of Global Macro at tastylive. We are here every day, Monday through Thursday, just after overtime, with a good friend of the show, Christopher Vecchio, head of Futures and Forex at tastylive. You can find my various musings outside of these shows on Twitter at Ilya Spivak. Good luck trading out there, everybody. See you soon. Godspeed.